Today, the RBA says rates are going to rise further. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and broad news with a distinctively Australian flavour. Well, the Reserve Bank of Australia Governor Phil Lowe appeared on the ABC 7:30 television programme last night. Actually, I can't recall the last time an RBA Governor did this, which to me signifies the importance of the event at this critical and uncertain time. And by the way, overnight, again, the US markets mostly slid ahead of the Federal Reserve rate decision tomorrow. In fact, views that a 75 basis point hike was on the table have been growing after last Friday's higher than expected consumer price index data for May. As a result, the Dow Jones Industrial Average fell 0.5%, 30,364. The S&P 500 lost just a little, 0.38%, to 3,735, and the Nasdaq added just 0.18% to 10,828. In fact, the benchmark S&P 500 suffers its fifth straight daily decline, marking its longest losing streak since early January. And the declines put the index down more than 20% from its most recent record high, in other words, a bear market. Bond yields continue to signal higher rates, with the 10-year in the US up to 3.479 and the 2-year at 3.439. And according to strategist Ben Emos and trader Tom Galoma, the process of transmitting monetary policy through US financial markets is actually hamstrung right now, and there's a risk that higher inflation expectations spiral and push the world's largest economy into, quote, an instant recession. Even those who don't see it as a base case scenario, like strategist Mark Chandler, says the market might be tightening faster than what the Federal Reserve wants and faster than what the underlying economy can cope with. So, in that context, what do we learn from Governor Lowe? Well, he said inflation will peak at, quote, a very high 7% later this year.
Inflation's high. It's too high. At the moment, it's 5%, and by the end of the year, I expect inflation to get to 7%.
And he's back next year. And he said it was reasonable to expect the cash rate to eventually reach 2.5% in line with the midpoint of the inflation target, but he admitted it was unclear how high rates would go and how quickly. He did say higher interest rates were required because there was too much, quote, spending pressure, and the time for emergency pandemic settings was over. But there's an extra $250 billion of savings, and that will help households contend with cost of living pressures and falling house prices. Now about that $250 million, the get out of jail card, which of course was used through the campaign, and last year, by the way, it's often repeated, and perhaps it's a very convenient number. Last year, it was used by Josh Frydenberg, of course, to encourage people to go on spending. Well, of course, people have been spending, so some of that buffer will actually be already gone, as shown by the falling savings ratio. And by the way, it's not equally spread across all households, so this is a convenient number, but it doesn't tell the full story. In fact, Lowe did concede that some marginal borrowers will be under pressure as rates rise, but that he had to take account of the big picture. Well, maybe, but the individual household and their finances is my focus, and I already see problems for many. While rate rises would be difficult for some borrowers, Dr. Lowe said savers would welcome the higher returns after years of near zero interest rates. So it's interesting he's now claiming that savers is his focus, bearing in mind that over the last few years he said, well, sorry about savers, it's all about borrowers. In fact, he defended rate rises as needed to tackle inflation by controlling demand. When there's a lot of pressure on capacity, prices go up, and higher interest rates will establish a better balance between spending and the ability of the economy to produce goods and services. And this is a very mechanistic view of how the economy works, And it just shows you that he's a long way from understanding the true reality on the ground. The RBA imposed, of course, that supersized 0.5% rate rise last week to take the cash rate to 0.85%. And if the cash rate is, say, 2.25% or 2.5%, you can expect mortgage rates to be considerably higher than where they are now. That's a problem. But he said he was not worried about falling house prices in capital cities such as Sydney and Melbourne, but that was because the central bank does not target house prices. Of course, elsewhere, the research from the Reserve Bank indicates that when rates go up, prices fall. And I think the last number I saw was maybe 15% per 100 basis points adjustment. So that's not very good news for house prices. But never mind, the RBA doesn't worry about house prices, so carry on. He did admit, though, that the RBA would also keep a close eye on the impact on consumer spending from falling house prices after the national house price values increased 25% since the start of the pandemic. We know that swings in housing prices affect people's consumption decisions. Absolutely right. It's the wealth effect. If people feel that the value of their house has fallen, they're going to spend a bit less. Well, we're already seeing that in spades in our surveys. We've got to remember as well that households have saved that extra $250 billion, and the current rate of savings is very high. Well, as I said, and falling. And unemployment is low, and the number of job vacancies at the moment is extraordinarily high. So there are a lot of other factors that are influencing consumption other than housing prices, and he said our job is to work out what the balance is amongst all those factors. In fact, despite speculation about a potential US recession, Dr. Lowe says he expected the Australian economy to remain, quote, pretty strong over the next 6 to 12 months. And the RBA now expects inflation to hit 7% late this year, up from its previous forecast of 6%. And he says that the global inflation pressures will be expected to ease from early next year, such as the high global oil price and pandemic-induced supply chain disruptions, with manufacturers of cars and computer chips already ramping up production. I think eventually it will come down, and partly will come down because of the global factors, Dr. Lowe said. Over the past year, petrol prices in Australia have gone up over 30%. So even if the current level of petrol prices stay where it is, the rate of change goes from 30% to zero, and that will help to bring down the headline rate of inflation. Now, watch this space very carefully. So he's arguing that it's the rate of change of prices that is the thing they're targeting. But, of course, if you are still paying 30% more of the Bowser, that's still more money going out of your household budget. So how does that work then? And he also went on to say another thing that's going to help is that the supply side problems in the global economy are being resolved. So he said inflation will come down for those reasons, but it will also come down because of the high interest rates. And he said he was not worried about a potential lack of alignment of the bank's monetary policy and the government's fiscal policy after meeting twice recently with the new Treasurer Jim Chalmers. The Treasury is forecasting an $80 billion budget deficit and gross debt of more than $1 trillion. And Dr. Lowe said the biggest fiscal issue was paying for the higher spending the community expected on disability, aged care, health care and defence. Now, of course, the real point here is that if some of that money that was spent trying to, quote, save the economy, unquote, was directed into those sectors, we'd be in a much better position. Remember all that JobKeeper money going to corporates who never needed it? And he said the options to afford the spending were growing the economy very strongly so that the pie is bigger and serving more funding for everything. That's the best option, and other options are to cut back in some others, but that's pretty hard. And the third option is to raise more revenue through higher taxes, and that comes with complications as well. So that's the biggest fiscal issue, he said. Asked if the government and the bank had overstimulated the economy during the pandemic, Dr. Lowe said during the early dark days of the pandemic, experts were predicting tens of thousands of deaths, hospitals being overrun, 15% unemployment, and economic and social scarring. We took out a lot of insurance, Dr. Lowe said. I think it was right to do that, but I accept that others will have a different view, and the Reserve Bank is committed to learning from that experience. We're undertaking a series of reviews about how we responded and through that period, and we'll publish those in the coming months. But we took out insurance. Maybe we took out too much. But in the time that we faced the decision we had to take, I think it was the right thing to do. Now, the last point he made was that the indications of low interest rates and no rate rises to 2024 was something that he said, well, we did caveat it at the time by saying, assuming our assumptions are right. I don't think many people heard that. And so he is trying to rewrite history a little and essentially walk away from the responsibility that he takes and should take for the fact that many people listened to what he said and took those very large mortgages last year at very low rates on the assumption that rates won't change until 2024. Well, the world has now changed, of course. And that was precisely the same time when Michael Zucker was spruiking people to get into the market and use the government stimulus programs to basically buy a property now because rates will always be low. Well, I'm afraid that I just don't believe that the RBA governor, nor indeed the previous government, can walk away and wash their hands and say nothing to do with us because the data has changed. They do bear a lot of responsibility for people getting themselves into tight corners now simply because rates have started to rise much more quickly. The bottom line is that they misinterpreted the early leading indicators of inflation. They assumed inflation was transitory when it wasn't, and that the inflationary pressures built much more quickly, therefore rates needed to rise. Now, to my mind, last November to now, just 6 months, was not long enough to completely rewrite the history story. The problem is rates were too low. We had inflationary pressures building because of their monetary policy settings, and now they're trying to dig themselves out of a hole. And as I've discussed before, we're now caught between raising rates to try and deal with inflation, whilst on the other hand dealing with all the fallout of raising rates. And of course, the problem at the moment is with the bond rates high, with liquidity in the markets under pressure, and the Fed looking as though they'll raise rates dramatically, we are in a very uncomfortable position. I think central banks have dug themselves such a deep hole. I really don't think they can get out. But then it was clear to me that Phil Lowe wanted to rewrite history just a little bit and essentially try and explain where they came from and why they did what they did. I'll leave you to decide whether you found that convincing or not, but I'll simply say he needs to do better. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.